Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've obviously been through the topsy-turvy world again of alert level 4. Now we're starting to get some numbers that indicate just how much of a hit we had through lockdown. What are we currently seeing?
Yeah, so our estimates are for GDP in the September quarter to be down about 7% on what would have been normal levels. And so that's quite a big hit, but not as big as the 12% drop that we saw, of course, through the initial lockdown last year, which did last a couple of weeks longer. So not surprising that it's not quite as big. And also, of course, we know that the economy is probably better able to operate under those sort of higher alert levels than it was previously when COVID first struck. Of course, you've been delving through the regional numbers and looking at the indicators through those. I mean, has there been a lot of variation across the different regions this time around?
Yeah, absolutely. Our latest quarterly economic monitor is showing quite intense levels of variation, not only through this lockdown, but also compared to last year. Remembering that the September quarter last year had Auckland in lockdown back at level 3 for a period, but also that was the time when we were seeing quite a lot of surging activity across the economy coming out of the first national level 4 lockdown. So the numbers, in a sense, are all over the place. We've got quite a lot of ups, quite a lot of downs. Quite a lot of different spending trends, for example, in terms of what would normally happen at that point of the year. What we are seeing, though, relative to normal levels, is at the moment, through this Delta lockdown, we've had the likes of Northland, parts of the eastern North Island, and the top of the south that have been some of the strongest performers. Remembering those sort of areas with a very strong primary sector base, they've been able to continue through. There's been a lot more underlying activity that's been able to continue. But at the same time, we've seen that, unsurprisingly, our tourism hotspots, but also our major urban centres haven't been going quite as well. Tourism ones are quite easy to understand. Of course, you don't have as many people that have been able to travel to those areas, but also for our metro areas, our metro centres and cities. What we've seen is that huge focus on working from home coming back very strongly again with the Delta lockdown, people sticking around their homes more. That's very much influencing the spending trends and just where economic activity is happening. The office is not nearly as populated this time around. Looking forward, though, I mean, how is the bounce back and the sort of spending surge going this time around, Gareth?
Yeah, I mean, the initial spending numbers, if we put aside Auckland and Waikato, of course, because they have been stuck at level 3 for longer than the rest of the country, but everywhere else that's been at level 2, we have seen a bounce back in spending, but activity's only been about 2% up on where it was this time last year. And if we compare that to 2020 coming out of lockdown, we were seeing right across the country, spending numbers were about up 5% on where they had been in 2019. So we know that we're looking at those figures. It suggests that the spending bounce back has occurred in some of those store types again, but not as strongly as we saw previously. We're also getting, some concerning signs from consumer confidence surveys, which show actually people's assessment of their own financial situation is at its lowest in more than 8 years now, and worse than it was with the previous lockdown and indeed earlier this year as well. So that's fallen away. It's only 1 month's worth of data, so we'll treat it a little cautiously at this stage. But it does raise some concerns when you pair it with those spending numbers about just how robust consumer spending will be going forward. There is a bounce back coming out of lockdown, but at this time around, people are grappling with higher interest rates as the Reserve Bank starts to tighten monetary policy. I think this lockdown has also been one not as short, sharp and successful as we had last year. And so there's not the sort of same feeling of success or certainty that we had coming out of the previous lockdown either. And, we're still trying to work out where the government is going with its traffic light system and how that's going to pan out in terms of summer and just how widespread Delta will become as some of those restrictions are removed. And we know, looking internationally, that generally speaking, people have got back out spending, back out eating in restaurants. But of course, in New Zealand, we've been in a mindset where any single case of COVID that's out there is bad and we want to get rid of it. And it's quite a shift for people to move to an environment where there will be COVID out there. Yes, 90% of us have got our vaccinations, and by the time Christmas rolls around, we'll have both vaccinations done. But I think there will still be a portion of people, we just don't know how many people it will be, who will be reluctant to get out there and go on with their spending. The other thing that will be, I think, hitting households' ability in terms of spending going forward as well is just how strong some of those price and inflationary pressures are. I mentioned that spending was up about 2% on a year ago, but of course we know that inflation's been running at around about 5%, and so it suggests, if anything, that the volume of spending has been going down. On a regional basis, of course, I suspect that those pressures have been, coming out differently across different parts of the country.
Absolutely, and it sort of highlights the economic challenges that are going to start emerging in some of our regional and provincial centres. Inflation's running at the hottest in the provincial North Island, and we are seeing that building costs are also significantly advanced, or more advanced, across parts again of those provincial economies. We saw that over the last year, building costs were up around about 12% per annum, but in the North Island, outside of Wellington and Auckland, building costs were up 15%. So there is real intense pricing pressures there. What's happening is you're getting that combination of supply chain issues really making it difficult to find the right materials, the labour market shortages in general, because there's still a lot of work to be done, but trying to find the right people with the right skills in the right places is becoming difficult. And because you do still have some relatively healthy demand, right? Some of those economies that I mentioned before, those regional areas, still doing quite well. So there's a lot of work that wants to be done, but just simply not the supply of resources and people to do quite that much. And it means that there is an intense battle for those scarce resources, and that means that prices are continuing to go up. Of course, households are continuing to feel those price pressures themselves. Rents, fuel, everything else seems to be going up and up. With those pricing pressures going forward, with interest rates continuing to rise at the same time, with the challenges around housing and similar, trying to get the right workers in the right places, all of those are going to combine, I think, to continue pushing prices higher over the next year or so. We know that shipping costs are still holding at 10 times the usual level. They haven't continued to go up, which is somewhat of a relief, but they haven't gone back down either, and they don't look likely to go back down anytime soon. And so with all of those pricing pressures, with people being still also a bit nervous perhaps moving into 2022, that is introducing some caution, I think, when it comes to what we think might be coming forward. Just a little bit of nervousness that maybe the bounce back won't be quite as good this time. I think summer's going to be quite a key indicator for us. If we have a better summer, again, things might turn rosy in 2022, but otherwise a little bit more of a compromised position. But I think we'll continue to assess that, how the different regional economies are going and what the bounce back does look like